Good day, fellow investors. Growth stocks are the hot topic: tech, autonomous drive, genomics, and as I'm a stock market researcher, all I do is researching stocks so that on my stock market research platform I can increase the number of stocks followed to at least 50 covered stocks in North America, Europe, Asia, and my goal is to look at as many stocks as possible and then constantly follow them over time and find the low risk, high reward investments out there. And that's exactly what we're going to do today with 11 growth stocks, and we're going to put them into a Peter Lynch perspective on how he sees growth stocks, the dangers with growth stocks, how to put them into a valuation table to see what's expected of them to justify the valuation and justify a good investment return. And then we're also going to conclude by discussing the strategy there, how to invest in growth stocks and what's the strategy. So don't be scared of high valuations of things like that. It's simply a part of growth stock investing, and we're going to look at it from that perspective. Also go through key concepts from total addressable market, growth, profits, margins, IPO, is it a trend or not, to give you an indication of the risks and rewards so that you can make the decision yourself. Let's start with Peter Lynch's discussion on the current stock market environment. What does Peter Lynch say about the market? So this is One Up on Wall Street 2000 edition, and if I read it, and I'll go through some quotes and I'll read them to you, and you can just exchange .com stocks with tech stocks or whatever you wish, and that will be Peter Lynch's warning, and from that warning, risk reward, we're going to analyze these stocks. Why am I discussing risks? Because this is from Zillow's presentation. Today's consumers expect push button magic happens exchanges. So investing is not really push button magic happens, and that's something by learning, by knowing more about investing, that I hope many will understand and protect themselves from the risks out there. With today's hot internet stocks, fundamentals are old hat. And the term old hat is old hat itself, proving that I'm old hat for bringing it up. So old hat fundamentals, similarly to the current environment. So we have to find those stocks that have good fundamentals that you can base an investment on. The mere appearance of a dot and a com and the exciting concept behind it is enough to convince today optimists to pay for a decade's worth of growth and prosperity in advance. Subsequent buyers pay escalating prices based on the futuristic fundamentals, which improve with each uptick. Owing to the lack of earnings in .com land, most .coms can't be rated using the standard price-earnings yardstick. In other words, there's no E in the all-important price-to-earnings ratio. Without the PE ratios to track, investors focus on the one bit of data that shows up everywhere, the stock price. The internet is far from the first innovation that changed the world. The railroad, telephone, the car, the airplane, and the TV can all lay claim to revolutionary effects on the average life, or at least on the prosperous top quarter of the global population. These new industries spawned new companies, only a few of which survived to dominate the field. The same thing likely will happen with the internet. A big name or two will capture the territory the way McDonald's did with burgers or Schlumberger did with oil services. Shareholders in those triumphant companies will prosper, while shareholders in the laggards, the has-beens, and the should-have-beens will lose money. So the typical .com has no earnings as yet. You can do a thumbnail analysis that gives a general idea of what the company will need to earn in the future to justify the stock price today. And he's doing that by looking at market capitalization, earnings, revenues, and what's behind the story to justify the growth rate. And he says that a growth story, a growth company should have at some point in time a price-earnings ratio to 40 on earnings. And that's exactly what we're going to use also in our table. So what will .com need to earn to support, let's say, a 100 billion valuation? To get a ballpark answer, you can apply a generic price-earnings ratio for a fast-growing operation. In today's had the market, let's say 40 times earnings, 2000s. To become a 100 billion enterprise, we can guess that .com eventually must earn 2.5 billion a year. So let's immediately start with Roku. IPO 2017, huge growth, this is 15 times, and especially great boom in 2020. The market cap is 15.66 billion. Revenues, there is growth, what is this, 30%, not profitable, and increasing the number of shares to finance the growth, as a normal growth stock does. Let's put it in my table. I've taken the name, the ticker, the revenue, the market capitalization, which gives me the price to sales when I divide the market cap with the revenue. I have the growth rate from the last year, and then I have put what are the earnings in 5 years that justify not the current market capitalization, but the market capitalization in 5 years. If I invest in a growth stock, I want at least my money to double in 5 years, which is a 15% return, which is not even that exuberant in the current growth environment. Many expect much more. But let's say 5 years, a double, what is it, 15-16%? Okay, fine. Let's do that, and let's see, okay, for this stock to double in 5 years, what should the earnings be on a price-earnings ratio of 40? And Roku, we come to 2.5 billion, and if we put a 10% net profit margin on the revenue, so 2.5 billion earnings, 10% profit margin means that they should have revenues of 25 billion. How much does Roku need to grow to reach 25 billion and then remain profitable? We get to 16 times revenue growth over the next 5 years to hit this fundamental support, let's say. The risks are margins and growth, because they have to grow, yes, 16 times, what did we say, and then also improve margins. Now, this is just a thumbnail overview, okay, and I hope to see in the comments, please just type, okay, Roku stock, and then type your thesis. Don't just type this, I think this. Please, really, let's give value in the comments. It's a lot of stocks. We can really learn by each other by sharing and, let's say, open source research that is now the common theme. So please share in the comments your thoughts. Where is this analysis of Roku, where it might be flawed, where are the risks or rewards? Alright, next stock, Square. The stock also, IPO 5 years ago, 2015, went from 12 to 241, big explosion in 2020. If I put this into the table, price to sales is 14, growth 46%. The earnings to justify a market cap of 108 billion that has to double in 5 years would be on a price-earnings ratio of 40 times 5, 200 billion for the stock to double. We are at 6.57 growth of revenues so that it hits 50 billion revenues for a 5 billion profit. So the risk with Square is the growth, because they are profitable. I see here 310 million in net profits, positive free cash flows, and you can see also how, as they are positive, the issuance of stocks probably is hopefully just for shareholders. So this is a positive, very positive in a growth stock when it has profitability, because it's good for the business model, which means that the business model is proven. The only thing is they have to grow this 6 times over the next 5 years to justify, let's say, the current valuation. At 50 billion, it's not that easy to grow as fast, 50 billion in revenues. And actually, if we go back to the stock chart here, when the stock price was 15%, 20% of the current one, this was on 300 million times 40, 50 price-earnings ratio. This was, let's say, a fairly priced earnings growth stock in Peter Lynch scenario. So there is always an opportunity, even in growth stocks, so let's look for more. Next one, Zillow, the real estate company, IPO'd 2011, so a little bit earlier, then jumped up and down depending on the trends with real estate, but not far up till recently. This is over 10 years. It did underperform the S&P 500, but since March, boom, explosion with a 34 billion market capitalization. Net income, however, has also imploded to the negative as the company is investing in growth. But revenue is okay, growing, really nice growth here. Let's put it into our table. So Zillow revenue 3.4 billion, market cap 34 billion, so it has to double to 70 billion, price earnings ratio 40, 70 divided by 40, we have to get to an earnings rate of 1.67 billion on 10% net margin. We are at somewhere 16 billion in revenues. So they need to grow around 5 times to reach that. So that's possible, especially as this is their plan to all this home buying mumbo jumbo that you get into when you buy something, put it into a button like we have said. So really make it more efficient. And their total addressable market is $1.9 trillion. If they get a fee of 2% of that, 2% of 2 trillion is 40 billion. If they get 25% of the market, then we are at 15, 16 billion. So they could reach if everything goes online, but you always have to look at this total addressable market. How much can they get of the market? How much will it really shift with the data and AI revolution? Of course, AI is the smartest thing on the block. And how much it will really shift and how much it will remain as is. So key concept, always look at total addressable market and whether it is possible or not. What are the chances that the company gets 20% of the total market out there? How much will it shift or not? That is what's priced into the risk and reward. Tesla stock, we all know the explosion. What is this? 200 times up for early investors. Let's look at what's priced in. Revenue is 28 billion, market cap 30 times, price to sales, growth 10%. That's the last year. It will be faster, I know, as they are expanding, so we can put 30-40% here. Earnings to be in 5 years, so the market cap needs to double to 1.6 trillion divided by 40. I need to get to earnings of 41 billion and thus revenue of 410 billion for growth of 14 times over the next 5 years. Will Tesla expand 14 times to justify this in 5 years? Unlikely, maybe in the next 10 years, but that's something which leads to the risk of growth and profit. Of course, they need to grow and they need to make it even more profitable than now. And the next concept when analyzing growth stocks is the incoming competition. When the business model becomes profitable, these guys are all business people. They want to make more and more money. So yes, a sector is growing and everything is okay, but when the margins, okay, this could be profitable for other data, tech, AI, smart businesses, what they do, they enter into the field to scale their technologies into that field. So that's also something to think about when it comes to competition. And we have seen last week, and also the news has been out there or not over the last years, that Apple is going to make also their own car or something like that. So that's again an ecosystem trying to get a piece of the pie. It might not be significant in the next 7 years, but down the road, which then again poses a long-term risk. Next stock, Pacific Biosciences. So the stock has been around for a little bit longer, up, down, up again, and now really exploded in 2020. Let's put it in our table. 80 million revenue, market cap almost 7 billion, price to sale 90, the highest of the ones, growth 0, so the market will have to just be created, so it's not yet there. So to double here we need 13 billion. 13 divided by 40 is about 300 million, depending, it's not that relevant now because these are long-term estimations, so the profitability should be around 2.6 billion for the company. They need to grow sales 29 times in the next 5 years. Of course, if they hit it, their total addressable market is minuscule now, but their expected growth rates are huge, and if they hit this and they have then, what, 50% of the market, then they might hit those targets. This is what they are selling. I don't know what's the competition. I'm looking forward to your comments for deep insights from those that know this company. Of course, huge issuance of shares over time to survive big losses on stable revenues in this case. And another concept here is, okay, what are the investments required for growth? Because for now they are doing research but not investing that much into capital and everything. But if they must grow revenues 29 times, then they will have to really increase cap spending, investing, etc., etc. And that's also a point that you have to calculate into the profitability of the future. But the stock has really exploded from July, what is this, almost 10 times up. Let's look at the purchases. Who was the biggest buyer from July? Gabelli was selling big, Wood was buying, Watsa was selling. If we just click on Katie Wood, let's see, she bought 11 million shares from July when the stock exploded. Smaller purchases in the past when the stock was much lower. So when the stock started exploding, also Wood started buying. Perhaps something changed. You will tell me in the comments. Next stock, NVTA, again 2015 IPO, 2015, 2016, keep in mind that year, we'll mention them later. And real boom from the COVID crisis. Okay, let's look at our table. Price to sales 36, grow 20%. They need to grow 18 times to reach 4.5 billion for 450 million to times 40 justify a market cap of 18. So growth, margins, of course, the key. And if we look at earnings, these earnings, as the company is growing fast, these earnings are also, the negative earnings are expanding. Which is again a key concept. Growth, yes, it's much easier to grow if you spend a lot of money. And many companies, as the market is focused on growth, spend as much as they can by issuing shares, capitalizing themselves, and then growing, because everyone is focused on growth and not on old hat fundamentals. So another concept to think about, growth and fundamentals, because it's easy. If you produce something and you pay $2 to make it and you sell it for $1, you're going to grow fast. Another fast growing stock, this is more of a bio stock. So again, no fundamentals, but also not even growth, because the growth starts when they get approved and when their, let's say, medicine is working, and then the growth is exponential or unlimited. Things have improved significantly over this year, and I'm not putting any fundamentals here because it all depends if what they are doing, in this case changing our genes, editing genes, if this works. If this works, perfect, you're going to cure a lot of people. Whatever they do, great. If it doesn't work, it doesn't work. So the concept here is a bet on the solution, whether it will work or not, a bet on the drug. So biotech stock, not really a growth stock, which is again a different category, a different investing strategy that we'll discuss later. But again, in line with this market where customers expect push button, edit gene, stay healthy, eat whatever you want, don't exercise, don't do anything, you just exchange magic button. Next company, TWLO, 2016 IPO, again run up, then nothing for longer. Keep in mind this, nothing for longer, and now again an explosion. Market cap $58 billion, 40 price to sales, growth 30%. Okay, this to double 120 billion, they should hit 3 billion in earnings on 30 billion of revenue, so they have to grow 20 times revenue to justify a stock price in 5 years, when maybe the market will look at fundamentals. Also growing really fast, but also burning a lot of money. Pure Storage, 2015 IPO, up and down, and not even exploded as many of the others, only lately over the last 2 months. Sales the lowest we have seen 3 times 87 price to sales growth, yes, 20%. They should grow 2 times to justify the earnings on a 10% net profit margin, but they are growing, yes, but burning money. So they should turn this into profitability at some point. For now, this is not improving much. Here there is a little bit of margin improvement, okay, but issuing lots of shares. So you have to see here whether the growth there will be justified and whether the margins will be improved. Docusign, again, 2018 we are here, and then jump recently, 45 billion market cap, price to sales 40. They have to grow 20 times for a price earnings ratio of 40 in the next 5 years. 20 times. That's a lot of growth ahead. And to conclude with the concepts, IPO trend riding. If we look at Roku Stock, 2018, 2015, 2016, all of these growth stocks have been, most of them, public over the last 4 or 5 years. So they took the 2015 IPO growth exuberance that subdued, and now they are reliving it on the changed environments. But as you have seen over the last years, it can be a lot of nothing if this momentum subdues, because of the fundamentals and the huge numbers that they have to justify for these market capitalizations. Now, on the strategy, how do I justify, let's say, a growth strategy? It's not all crazy growth. There is also a sense to it. Let's say you buy all these 10 stocks and you make a portfolio of 10 stocks, you put 1,000 into each, 9 go bust. And one of all these stocks, just one, goes 10x, then okay, you didn't lose anything. If one goes 100x of all of these companies, then you have made 10 times your money, let's say in 10 years, and that's a remarkable return. So all growth investors know that most of their growth stocks will go bust or fail or something like that, but only 1 out of 10 or 1 of 20 needs to make it big to have really great returns. However, if you get 10 that go bust or do badly, then your returns are really bad. But justifying the growth, the name of the game is 1 out of 10. To conclude with Lynch, in spite of the instant gratification that surrounds me, with all those stocks going up and up, I've continued to invest the old-fashioned way. I own stocks where results depend on ancient fundamentals, successful company enters new markets, its earnings rise, and the share price follows along. Or a flawed company turns itself around, the typical big winner in the Lynch portfolio. I continue to pick my shares of losers too. Generally takes 3 to 10 years or more to play out. How did it work for Lynch? When he was fund manager at Magellan, turned $1 in 28,000 in 13 years, and for his wife he turned about 3,000 into 8 million, but they took 3 million out of that for partying and charity. So that's Peter Lynch, and the key here, I think, is this. From 1997 to 2090, and that's also the investing on this channel. We want to invest from 2021 to 2059, so if you are such an investor, click that like button and consider subscribing if you haven't. And many of these stocks are going to go down like this.